Yes.
Okay.
Dude, I'm just practicing. Practicing to pull the plug.
What kind of, we were talking about end of, I guess, your healthcare directives. What kind of ethical dilemma would it present? I'll tell you a situation I was put in before we are recording right now. That if you were in charge of the healthcare, now think about a parent, think about a loved one, think about, we can use love, we can use greed, we can use any emotion there. But a situation I was placed in at one time was, I had a client, when they come in and do estate planning with us, we talk about healthcare. I make sure they have a healthcare directive. I make sure they have a power of attorney. I make sure they have a power of attorney for financial matters, for healthcare matters. It's all drawn up by our in-house attorney. We have a file of it. We keep it on file. And I let any interested party know that we have it on file, but they get to go home with it. And I had a situation where an elderly lady had in her directive, she did not want any type of artificial help. If she stopped breathing, or her body just decided it was time to check out of here, she would be gone. The daughter could not bear to see mom go.
See it all the time.
Now, what do you think if that news comes back to my office? Should I send something?
Mm-hmm.
Yeah.
That was the wishes.
And that's what
You have an obligation to your client.
And that's what we did. We sent a copy down to the hospital. We sent a copy to the daughter. The daughter's still a client of the firm. The daughter still stayed with us, and she later realized we made a good decision in that we were honoring her mother's decision. But again, that brings up a good point of making sure that that directive is in somebody else's hand and other people know about it. Number one, make sure it's readily available in a tough situation.
I always hate that. That's the worst. And you have to do continued care and continue to heroic measures for a patient you know doesn't want. Makes you question why you do what you do. You're like, I didn't sign up. Not why I'm here.
And advancements in medicine
And keep you alive for a long time.
they can keep you alive for a long time.
And it really goes against a lot of your doctor's nature.
Well, you know, when it comes to that,
That's just
here's my
they
thought
want.
process I always come up with. Who remembers Dolly?
The land.
The clone.
I firmly believe, and I said this is my personal belief, but that's when that line was crossed. You know, at that point, we created life. And in today's, you're right, we can extend that beyond any measurement that we've ever seen before. What else from outside? Something big happened today.
Plagiarism.
Plagiarism.
Oh, don't go into the politics.
I'm gonna go into the
I won't.
Let's keep this within health.
I just know how it
Let's keep that within health.
I wasn't
Outpatient fees.
the potential blocking for
How do y'all
the
get
health
paid?
insurance mergers. The health insurance.
How do you get
mergers.
paid? What's your sources of payment?
Medicare, Medicaid, and private health insurance.
Third-party payers. Something big was happening today in the third-party payments.
Today the day that Aetna and Humana were supposed to merge.
Well, it's not the day they were expected to merge, but the Department of Justice issued reports today that said they were ready to file legal junctions against the merger, both mergers. Aetna, Humana, and Anthem and Cigna.
Yeah.
But it was big news here in our Louisville market because, again, you know, I think that's the one that they expected. Both of those companies have been divesting themselves of certain assets, hoping that by divesting, they would be able to create an argument that no antitrust, no monopolies would exist, free competition would be available. And evidently it did not go into that far. So that was the big breaking news on, what was that? Chapter 6, cost accounting. Somebody tell me what is cost accounting. Put your accountant hat on now.
More or less the planning part of it where you're figuring out how much whatever's in your budget is actually going to cost you. It's kind of a vague way to put it, but it's more or less figuring out how much an item's going to cost you and what the bill's going to cost you ahead of time.
Expand on that just a little bit. Look to your textbook.
How are you gonna allocate those costs?
Classifying costs, allocating those costs, assembling costs, and determining product cost. Cost accounting, you are going to take all of those. You're going to try to trace the cost back to any particular product, or in our case, any particular type of service that we are providing. What methods can we use?
Financial accounting costs and managerial accounting costs.
Tell me, what is financial accounting cost?
The amount of money used for a certain purpose.
The amount of money used for a certain purpose. All right. What's the managerial side say?
Costs that help management make better decisions, such as the cost derived from budget reports.
All right, and I want you to think about, you're going to use these two terms as they're interchangeable throughout other disciplines of accounting. Whenever we talk about financial accounting, again, we're talking about the dollars and cents, the actual reporting, both internal and external reporting. We talked about that. Managerial is going to include, and keep in mind that financial accounting, one difference is financial accounting must adhere to one specific standard. GAAP, or the International Financial Reporting Standards in the international spectrum. Managerial accounting does not have any set standard that it must follow. Instead, it's internal procedures that are put in place based upon the unique abilities or the unique needs of each party, each inside party. Now, how do we trace our cost?
Whether they're direct, indirect, average cost, or full cost.
What's a direct cost? Labor.
Trace directly to department, product, or service.
Say utilities.
Supplies, labor.
If it could be traced specifically back to that product or service. If it was utilities for an entire building, probably not. What's an indirect cost?
Like your utilities, your overhead, the cost of the department. I mean, the building, not just the department.
Overhead.
Kind of like what I was saying, utilities would be.
Think of it that way. Yeah, whatever is the, anything to just think of it as a broad general cost that can be spread across many spectrums. All right, how could we further classify cost? This is kind of a review, but you guys are on fire here right now, so.
Behavior in relation to volume of product or services.
Well, let's look at a variable cost. How do we distinguish between variable cost and fixed cost?
You mean, are you wanting specific like examples or?
Yeah.
Well, let's say that you have a certain department that is run by one employee, but you can't, that employee has to be there no matter what. So that's something that's going to be like remaining constant if you have one person that you have to employ there. But the variable cost might be in another situation, you have a department that has multiple employees, and since this goes down and you don't need as many employees, you can essentially not schedule as many employees or send them home early to try to cut your actual operating cost.
Summarize that.
Okay, you have 4 people, you don't need 4 people, you only need 3, send one of them home. But if you're in a department where it's just one, you have to have that person there no matter what the volume is, you keep that person there. That's fixed and variable. From a staffing standpoint.
I think of variable cost again. One in the discussion boards you had, a lot of you talked about unpredictability, decline, unpredictability when it comes to budgeting, setting revenues. I forget which discussion it was, but I saw cited anything around prom season. You saw an increase in ER
yeah,
activities.
that was me.
Okay.
Rehab.
Something around, we'll just say certain events, you would expect to see more costs associated probably during Derby, yeah,
Forecast.
events that we're bringing in,
Fair.
Again, a variability of expenses or variability of cost. The example I always use here, how are your instructors, how are your adjuncts here at Ottawa paid? Y'all have any idea?
One check at a time.
One check at a time. I'm glad we have that recorded. I did not say that either. No,
Report.
keep in mind, no, we get a base pay, we have a base compensation, but we're paid based upon enrollment. Okay, so if I have 20 students in here versus 1, my compensation is greater for 20 students. My workload increases based upon more students. My compensation grows with that. That is an example of a variable cost. A fixed cost. Speaking of Ottawa, Indiana, what do they own this building? No. They lease this building. They pay a monthly payment to use this building. Now, using that same example, does their lease payment change based upon if they have 20 students in here per week or if they have 1? No, it's a fixed amount regardless of the activity that occurs within it. That's a good example of a fixed cost. So again, if it's based upon and varies based upon activity, variable cost. If it does not and it remains fixed, we'll call it a fixed cost. All right, semi-variable cost. All right, just know that this is one that's going to respond. I'm one of these people, it's either variable or it's fixed. Semi-variable is just going to say if it's a small incremental change, just know if it's still a change, it's a variable cost. Now, marginal cost. This is important. This term marginal, it's an important term that you will want to latch hold of throughout your studies of accounting, finance, economics, statistics. We use the word marginal interchangeably in each one of those disciplines. So I'm not saying anything quantitative. When we refer to marginal, we refer to one certain word. If I talk about a marginal cost, what am I talking about? The cost associated
Producing one more unit of something.
Jennifer has heard that before from me. The cost associated with producing one additional unit of output. If you hear anyone talk about marginal revenue, if you're an economist talking about marginal revenue, what's the revenue associated with one addition? So just note, whenever you hear the word marginal cost, marginal benefit, what's the benefit of one additional unit? It's always one additional unit. Why do you think it's focused on one additional unit? What's the goal of your organization?
Maximize profits.
Maximize profit. If your job is, you as a for-profit entity, your goal is definitely to maximize profit. In order to maximize profit, there's always a chance that you can produce one additional output, still reap positive financial rewards off of that. You could still probably greater maximize profit, or at least move closer toward that. You know, in a perfect world, you would push it up until marginal benefit always exceeded marginal cost to that point to where they flipped. Now, if you could ever truly get to that point, you have maximized profit. All right, what's all these other costs that the book gives us? True costs, controllable costs, uncontrollable costs. Specifically, let's look at, I think, control costs and uncontrollable costs. You should be able to derive from this the name. Differential cost.
It's the cost associated between two different alternatives.
Two different alternatives. All right, two costs that are dear to me. And again, when I say dear to me, remember I come from an economic background. Sunk cost and opportunity cost. Sunk costs, costs that have already been incurred and thus do not play a role in future decisions. Let me give you an example. Your department needs a new piece of equipment. And IT or whomever is in charge of running and making that recommendation. And recommendation is made that you buy this piece of equipment. And now all of a sudden it's bought, and you quickly identify it's not what was needed. It does not solve the need. Do you stop right there and cast blame and do without? If that need is still there, do you do without? Or do you cut your loss and go out and acquire what you need in order to fulfill your purpose? A sunk cost. We use the word sunk. It's already been made. You can't go back and reverse it. And sunk costs are always irrelevant in current or future decision making. So just think about it, let it go in the past. Now, your controller is not going to like that situation. The CFO is not going to like that. And somebody might lose their job over it, or at least have a lot to explain. However, if it did not fulfill the purpose, and the purpose is still there, the goal is still there, you must cut your losses and take the step in the right direction. Opportunity cost. Jennifer, I'm going to pick on you. You've had me in economics before. What is your opportunity cost for being here tonight?
Receiving a bachelor's degree for higher salary at my company. So opportunity cost would be what my potential earnings would be by.
Somebody help her.
Opportunity cost would be, for example, let's go back to that clinic. Let's say the clinic that the CEO, previous example, was actually successful but did not have X-ray equipment in it, and they saw potential because they were losing potential X-ray exams to a competitor or something, or just not getting them at all. They could install an X-ray machine, is given an example here, to possibly not just recoup the cost of the X-ray machine, but to help with overall revenue of that clinic.
Let's first use to answer this question. What's your opportunity cost for being here tonight?
Future wages.
It's
What'd you
Is
say?
it future wages could increase by having the
It's
degree?
our time away from home.
Yeah,
time away from home.
there you go. What would you be doing if you were not in class right now? If you could just walk out of here right now and do the most, what would you choose to do if the sky was the limit within what you're actually capable of doing?
Specifically.
I'll be drinking some wine.
Me personally, if I was not here teaching right now, it's still daylight. I would either be playing golf or I would be wrestling with my daughter. I'd be playing with my daughter. Those are the two things, those are the two best alternatives that I would be spending my time with by not doing here. I'm giving up time on the golf course. I'm missing time with my daughter for being here. So my opportunity costs are those two items. So it's what you're giving up by choosing another alternative. And I would say it's the most important thing that you're giving up. Your true opportunity cost would be that single most important item that you're giving up in order to be here. So in the clinic, what would be a good opportunity cost example? What do all of you need to operate?
Patience.
No, you need something more than patience.
You
Because
revenue.
you need patients that are capable of what?
Paying.
Paying.
Paying customers.
You need revenue. You need dollars. Okay. Is there a limitation on the amount of dollars that you can get?
Depends.
Depends on what they're.
Now remember, there's a limitation. If you went in right now to your CFOs and said, would you like to have more revenue? I probably would say they'd probably say yes. All right, so there is a limitation on how much revenue you can have. This is the true study of economics. There's a limitation. There's a definite maximum amount of revenue that is obtainable to your organization. Therefore, now, dollars can be a definite amount. The needs might be uncontrollable. The needs might be unsatiable. They can't all be filled. Okay, so they've got to take that dollar, they've got to take all the revenue that they get and somehow spread it out. Now, when they pay your salaries, for example, that's dollars that they can't allocate somewhere else. Again, that's money that has been spent on you. So an opportunity cost could be, what else, if they were not paying your salary, what else could they be doing with that money? To that example, buying a piece of equipment. If we were going to make this big capital purchase, we're going to buy a piece of equipment. What is our best alternative use for that money? Meaning, if we did not buy that equipment, what is the best alternative for us to do with it? Opportunity cost. Talk to any economist. They're going to tell you that's what they'll smile. They'll smile and probably go on a big long lecture about it like I was almost about to. All right, methods of allocating cost. This is on page 135 in the text. All right, do you all have cost centers?
Mm-hmm.
Yeah. Have you ever heard of a revenue center? All right, revenue center. That's going to be your department that is responsible for generating revenue. Now, you have a revenue center. They just might not call it a revenue center. But you do have someone who's responsible for generating revenue. Who would that be?
Billing department.
Who?
Thinking the billing department who's actually processing the claims and getting payments from the third-party payers.
No, I would think whoever is actually what you're getting paid for. I'm not going to put not so much to say it's your medical staff or you all, because you're getting paid. You're the revenue. You're the ones that are generating revenue. That's going to be some combination of the services you're providing. I might even challenge a marketing team or somehow advertising team, somebody that gets that message out about what you do.
My department doesn't generate any revenue.
You would not be, based on what you've told me, you would
No.
not be in a revenue.
No. I'm an expense.
You're an expense.
I'm an expense because of the government and the Joint Commission.
Plaza, I work full-time with IT. There's another area that I work within hospitals, process improvements. We do like Lean Six Sigma. Our idea is to find ways to more efficiently, I don't want to say cut expenditures, but find more efficient ways to help us save money. So I don't know if that would be considered a revenue center or not. You have to spend a little bit of money, but you have the potential to save more money. So I don't know where that line really cuts.
Do you generate revenue?
I guess technically, do we generate it? No, but do we take processes that might have cost X amount and find ways to make them cost a whole lot less? I don't know if that's technically generating revenue or saving revenue. I don't know if they're one and the same.
If you save revenue, are you generating revenue?
No, technically no.
All right, so let's look at this study. I'll give you an example. Mr. Shepard is a patient at a hospital. He's admitting, complaining of stomach pains. Test reveals that Mr. Shepard had an inflamed appendix and surgery was indicated. Once the surgery was completed, Mr. Shepard spent 1 day recovering in the hospital. The surgery was routine and there were no complications. Discharge was as planned. All right, now think of what 4 departments we would have affected here. I'm going to give them to you. HR. Somebody had to come in and get the room ready, so let's just call it housekeeping. He had surgery, so there was the surgical team. And it says tests were completed. So I'm going to say a lab was involved there. Okay, so of those 4 departments, how would we appropriate cost to each one of those? How would we appropriate the cost to each one of those departments?
First, look at the fixed costs. The things
I want you to pages 430 or 136 and 137.
Step down and double.
Okay, which one of these are we going to use?
Step down is allocates from non-revenue, so double.
All right, direct. Cost allocation method that moves cost from departments that do not generate revenue to departments that do generate revenue. Step down. Allocates costs from non-revenue generating cost centers to other non-revenue cost centers. Look at Exhibit 6.1. You see a non-generating department. This is under a direct appointment. Non-generating is going to feed into the revenue generating, is going to feed into the patient, and just back that process back up. Patient revenue generator is going to generate revenue from the patient. That's going to go back to the non-generating department. What do we have in a step down? You see the 2 non-generating departments are passing back and forth. But at the same time, who are they both feeding over to?
Department that generates revenue.
Departments that are generating revenue, which again, that revenue is being generated from the patient. All right, so those departments, HR, housekeeping, surgery, and lab, Who's your generators?
Surgery lab.
Surgeries. All right, housekeeping and HR. I want to say non-generating, non-revenue generating. Lab, you can probably argue that. We might want to look closer at that, but I don't know that it would actually, it might support what the surgeon, somebody's had to send it to the lab because they suspected something. So they had to order the, I mean, I'm going to guess a doctor came in and looked at and ordered these tests. So again, in order to get to those.
But we did that as outpatient, so we still mail it.
We don't get anything in outpatient into that.
I had a compliment heard today from your all's hospital,
Really?
from someone who was there today.
Oh, good.
Good.
Makes us
I was very pleased.
We're a new place. We are.
And it was actually Patrice's dad.
Oh, yeah. Took care of him yesterday.
And she gave me permission to share that with you, so.
Thank you.
All right, now let's go over to page 142 and look at some ratios and we can wrap up chapter 6. Everybody understand what a ratio is? All right, so ratio of cost to charges. This is where we're going to take product cost and relate it to its cost to its charge. A method of determining product cost by associating its cost to its charge. What are we charging for something versus what is it costing us? Okay, I can tell you that it's not just hospitals that are looking at that. If you were a merchandising company, you would call that term a gross margin. Okay, what are we earning off of it? What's the cost associated with getting it ready to be performed? Getting it ready to us receive that revenue. Job order costing. What's going on here?
The way I took it was more or less take everything it costs to generate that product on average and try to come up with some sort of fixed amount to say that X procedure, X test, X item will cost this amount of money. Kind of good for budgeting and planning purposes. So that relative value unit comes into play where you essentially try to put an RVU on a specific test.
All right, you're going to do a sample of all the things that you provide, and you're going to get what those actual direct costs are.
Correct.
And then what are you going to do? State it one more time.
What am I going to do after that?
What are you going to tack on top of those direct costs?
Whenever I'm doing my budgeting, I'm going to try to figure out how many of those things that I produce or perform a year so that I can have a better guess of whenever I'm doing some sort of budgeting plan. How many of those RVUs I can allocate to a specific resource.
How many of those, what are you earning off of? What are the costs associated with providing this particular service? Now, again, how many of those do I expect to do?
Yeah, that's the game.
And here's where the skill comes in of knowing your business is, again, it's an estimate, like most concepts of budgeting, but you've got to put that multiplier in there. You know what that direct cost is going to be. Now, you've got to put that multiplier in there, and that multiplier being the quantity of times we are going to perform this. And again, you want to make sure that you have an accurate, or at least as close to an accurate cost as we can. Activity-based. You see an example of job costing on page 145, or excuse me, 143. And again, the next one being activity-based over on page 145.
A pretty good example of this. I wasn't able to collect all the variables, but this, in a nutshell, was this. Put with the task one time of figuring out per the type of exam that was being performed in a department, how long it actually took for that task to be completed. So in theory, to see how many could be done within an hour, if you were to take that data, combine it with the data that we already talked about, you could more or less figure out how many exams or tests or surgeries or whatever you're quantifying, and figure out how many you could do in an hour or a day or a week. Once again, taking the supplies, the labor, the equipment cost through depreciation. You know, depending on how deep you want to go with it. But that seems to be what.
I want you to look at two different terms. With job order costing, a method of determining product cost by sampling actual direct cost and assigning a relative value unit. Sampling actual direct cost. With activity-based, a method of determining product cost by using indirect cost. So you're going to assign those cost drivers based upon indirect cost. Look over at problem 6.3, page 145. Somebody define profit for me.
That's the amount of money that you have left after you've paid for all your expenses to be able to do whatever the service is.
Take in all your money, and we'll call that revenues, pay out all your expenses. What do you have left in your pocket? You get your paycheck, you cash it. You go home, you pay all your monthly expenses. You pay taxes on it. What's that cash you have left over in your pocket? That's your individual monthly profit. Now, the importance with that is you nonprofits, no. For a for-profit entity, who owns you?
What's the name of it? Rialto.
Who?
Rialto.
Okay, Rialto. Whoever owns Rialto, that, who?
Lennar.
Okay. Whoever owns Lennar, when we get into individual entities, that's who that profit belongs to. Now, you nonprofits, that's kind of, I'm expanding as an accountant, I'm expanding onto that term of who has a claim on that profit. If you're a for-profit entity, your shareholders have a claim on that profit. You nonprofits, you don't have profits anyway, do you? That's what everybody
Really
thinks.
Jewish, haven't you?
No, I say that jokingly
You
because
know,
everybody
that's-
thinks we're a nonprofit. We don't need a profit. We don't need a profit.
No, you have to make some money.
I hear that term all the time in these classes.
You have to make money so you can go to Jewish to keep your place open.
All right, the last thing I want to point out to break-even analysis. All right, let's look at an example. On page 151. Considering a new product with a fixed cost of $1,000, a charge of $10 per unit, and a variable cost of $5. What's the break-even analysis? How do we get it?
That's
Break-even quantity. They're taking $1,000,
Fixed cost.
which is my total fixed cost, and they are dividing it by the contribution margin percentage. Okay, so my total fixed cost is $1,000. Charge of $10 per unit and a variable cost of $5. So look at what's going on here. This is a good understanding of capital expenditures. Before a capital expenditure is ever exercised, your purchasing department, your finance department has run a break-even analysis on it, because in the worst case, they want to know that they're going to break even. Remember, the job is to maximize profit. They will define this once you have the units. The next question that would be asked, and this is when you would apply either job-based or activity-based costing, you would look at it, or you would communicate it to your revenue center. How quickly can we produce 200 units? My break even is 200 units. How quickly can I achieve that? Okay, that would identify if that capital expenditure is made, at what point in time do I expect to be paid back? The contribution margin, there it is. So we see it's a cost of 10, and it's going to cost me 5 to put it in. All right, do we have any questions over cost accounting?